counter that we're focusing on today is Godrej Consumer Products on the back of its Q1 earnings. Well, good volume growth, but margins are still weak. And to discuss as to how the quarter has gone by and how things are shaping up, we're joined by Aasif Malbari, the CFO of Godrej Consumer, joining us now. Mr. Malbari, always a pleasure speaking with you. My first question to you is about margins. Overall, this quarter has faced pressure in terms of margins, and even the recovery has been a tad slow. And this is, I believe, on account of higher inventory costs. There are pricing that's causing this pressure, plus there is competitive stress as well. Just want to get a sense as to what's your outlook on margins. You've said that it might improve in second half, but in terms of the overall trajectory, as to when do you get back to the normative range of margins?
Sure. No, great. Thanks, Mahima, for having me on the show. So in terms of the performance on the results, I think firstly, it's been a strong top-line performance. We've sequentially improved, delivered a consolidated top-line growth of 10% with a very, very strong underlying volume growth of 8% at a consolidated level. So really happy with the way the revenue growth is shaping up, and we sequentially actually kind of just improved the position. When it comes to profits, it's been muted. It's been a flat growth in terms of profit, primarily coming on account of commodity pressures in India. Not really too much of a surprise. In May, we had guided the street saying that we will have a better margin performance in second half compared to first half. And it's broadly playing out that way. Commodities had peaked in May, June. They started kind of coming down thereafter. So we are seeing the peak of commodity costs. Consuming costs are much, much higher than replacement costs. And hence, first half margins are bound to be under pressure because of that. But we definitely see our margins get back into a normative range by Q3 onwards.
Okay, all right. So normative range by Q3 is what you're saying. Okay, in terms of the overall demand scenario for soap, because that has been the overhang. Even if you see the overall performance, it's been a good volume growth, and barring soap, it's been mid-teens, which is not the case in any other FMCG companies, right, Mr. Malbari? But there's something that's not working in the soap space, and one of your peers has managed to do well in the segment. What is it that's not working, and what is the kind of strategy in place that you're going to adopt to help this particular segment grow?
No, you're right, Mahima. I think if you look at the India growth, if you are to kind of just exclude soaps for now, it's been actually a stellar performance. We've kind of hit mid-teens across the range of portfolio. All our categories have actually done well. Hair care, hair color, household insecticides, everything is kind of sequentially kind of moved up. So very, very happy with the rest of the performance apart from soaps. Soaps has been a severe case of a lot of pricing going in because of the commodity costs and rebalancing happening. Grammages have been titrated downwards. There have been multiple changes on this front. And we do see stability kind of coming in, I think, in the next few months, because we would have kind of peaked in terms of all the increases which had to be passed on. And hence, again, from a Q3 perspective, we do see an improvement. It will be a sequential improvement from here on. Possibly we are seeing the most difficult kind of quarter in terms of both soap margins and volume titrating in favor of price.
Okay, all right. In terms of the international business, because I was looking at what you said, con call plus your press release as well. Indonesia has been the pressure point, right? Because there's flat volumes. There's also revenue degrowth of around 4%. But Africa business has done well, and to a lot of extent, that has kind of offset the negative performance of Indonesia business. But just want to understand as to what's not working there. From what I understand, that your pricing there is higher than people selling the same products there. Is that correct? And if yes, do you think that lowering the prices might not be the right approach? But then what is it that you're going to do to bring back the kind of volumes and revenue growth in the Indonesia segment?
Sure. So I think before we deep dive into Indonesia, if you were to just look at the larger international business, the last 2 years has been actually a very good performance for us on the way we shape the profitability of the international business as the complete business together, moving from 10% to close to like 17-18% improvement on margin. So the margin profile has become quite good. It's become a healthy business for us internationally, and now it's about growing in profitability. During the course of this quarter, we did face some kind of a macro headwind. The overall growth have slowed down in FMCG in Indonesia. And to top it off, we did see some kind of a competitive pressure on pricing. We do see these as temporary blips. I don't think this is going to kind of sustain for long. So in a few months, we should start getting back into both top line and revenue and EBITDA growth in Indonesia. So it's in some segments we are seeing some extra pricing pressure, but these things kind of settle down in a few months' time. Don't see a structural issue on that front.